Liquidity isn't hard, it's misunderstood, and it's the most important thing in all of trading. And without liquidity, you cannot be a consistently profitable trader. So in this video, I'm going to teach you what liquidity is and how we can use liquidity sweeps to get into the best trades possible. Okay, so we're on gold, and this works on all markets, by the way. Any financial market, liquidity works on. And so we're on gold, we're on the daily chart, and to do this, to do any sort of liquidity analysis, we need one higher time frame and then one lower time frame to enter on. That's it. The higher time frame gives us our direction. The lower time frame we use for entry. It's that simple, right? And you don't need to use the weekly, daily, 4-hour, hourly chart, all of them combined. You just need to use one time frame. So we're gonna use the daily chart because this is what all smart money are looking at, right? Goldman Sachs, JP Morgan, all of them are looking at the daily chart, and they're looking at the daily chart for one simple reason. They have billions of dollars to move into the market. They cannot do it on the 5-minute and 1-minute chart like we can, right? And the only way they can get into the market is if they essentially trade or get into their positions where there's lots of money. Now, where there's lots of money, that's what we call liquidity, right? Liquidity means how easy it is to get in and out of a position, right? And it's easy to get in and out of a position because there's lots of stop loss orders. There's lots of money there. So right here, we've got triple highs for gold. We've got one high here, and we've got a third high here, right? Lots of people are going to think, right, like price did here. They're going to think, right, that because price came down, and when it comes up again, it's going to come down. They think this is really good resistance, right? They think this is really good resistance, support and resistance. We all try this as beginner traders, and we weren't profitable with it because it does not work, right? It does not work. That's not why the markets move. The markets only move for liquidity. And if you'll notice, you might be saying, oh, well, it worked here, right? It worked here. Price came up and it bounced off and went down. The only reason price did that was to get more and more people shorting gold, right? If you just zoom out on the daily chart, we're a massive bull market in gold, right? So the only reason price did that was to get lots of people to start shorting gold, right? So we know at these levels here, there is so much liquidity. Let's just move this down. There is so much liquidity, right? There's so many stop loss orders. There's so much money, right? There's billions and billions and billions of dollars worth of stop loss orders, all at these highs here. So what smart money are going to do? Smart money, this entity that actually moves price, what they're going to do is they're going to force price up to these highs. And then once price is in these highs, they can start buying and selling. Whatever they want to do, they can get into that position because there's billions of dollars there. They cannot get on the 1-minute chart and just press, buy and sell like we do, right? They don't have the luxury of doing that. They can't just buy randomly. They can only buy at certain areas because they put so much money to move into the market. So the only thing we use for liquidity, right? This is all we need to do for liquidity is we just need to target it, right? We get on the higher time frame, we find the next obvious liquidity pool, and we just target it. We use it to give us our direction for the market. That's it. It's that simple. We don't need to do anything crazy about liquidity. So right here, we know, right? We know that price is going to come up and it's going to come and take out these highs here, right? Price is going to come all the way up, like it's on here, come all the way up, take out all these stop loss orders, and then we don't know what price will do next. It could continue up like this, right? Continue up and then go to all-time highs, or what it could do, right? What it could do is price could come up, take out these highs here. Smart money can get into their position, and then they could consolidate. It could reverse a bit and go down. Like, who knows what can happen? But what we do know is that at key highs and key lows, smart money will move price there so they can get into that position, right? That's what we know, right? So that's the only reason why these markets move. So we've done our liquidity analysis on the daily chart. We know that price is bullish. We know that price is going to come all the way up and to take out these highs. All we need to do now is get on the lower time frames and look for a simple entry pattern, right? And then we combine the entry pattern with a liquidity sweep to give us the highest probability trade possible. So let's get onto lower time frames and look for a simple entry pattern that's bullish. Okay, so run the 1-minute chart, and you can do the exact same entry on the 5-minute or 15-minute chart, or even the hourly chart. So here we are on the 1-minute chart. If we just zoom out and we zoom all the way out, this is that key daily high liquidity pool. Now we don't have to target this on the lower time frames. We don't have to target this. We just need to trade in that direction, right? So we only use the higher time frame liquidity just to tell us that we're bullish. So all we need now is our entry pattern, and right here. And this is so important. This is probably the most misunderstood thing in all trading. Right here, we have something called a liquidity sweep, right? Now, a liquidity sweep is essentially, now we know that we're bullish. We did the work on the higher time frames. Essentially, let's say we have some bullish price move up, right? Price comes down, it just wicks down, takes out your stop loss, and then instantly moves up in the opposite direction. That right there is a liquidity sweep, right? It was a fake move. This move here was a fake move designed just to take out stop loss orders. And then any retracement after a liquidity sweep, right, is super high probability. So we want to enter any point around here, right? Very safe place to put your stop loss here because it's already taken out stop loss orders. Then you want to ride price up. That is what liquidity is as like a basic overview. And it's literally the best entry in all trading, right? I've traded for years, 4 years. I'm an ICT chart student. That is the best entry in all trading. It took me at least 2 years to figure this entry out. And then it took me years to actually master it. But nevertheless, here we are, right? So right here is a liquidity sweep. You see, let me just make this clear, right? You see how price comes down, it takes out an old low, quickly and aggressively moves off in the opposite direction, right? That is our liquidity sweep. And then any retracement after that is high probability. Now, you might be asking, let's remove this. You might be thinking, oh, well, there's probably not much, not many people are going to have their stop loss orders at this amount. Now, you might be right. There might not be many people who have their stop loss orders here, but there are so many algos that are coded to put their stop loss at key high, or not at key highs, at any high, any swing low, right? They're coded just to keep buying, keep buying, selling out highs and lows. That's, 70% of the volume of these markets are all algorithmic, right? So there are algos that are literally 51% profitable. Their win rate's 51% and they get a 1 risk to reward ratio, but they make like a million trades in a day. So, over the long run or over a million trades, they are like quite profitable. But anyway, at highs and lows on any major financial market, like gold is one of the most highly traded markets. There are spots are at every high and every low. So there is liquidity here, right? Now it's not as much as like the 4-hour or daily chart. There is enough liquidity here for it to be a liquidity sweep. So right here is our fake move, right? Fake move. Look at this wick. This wick only comes down to take out this low and it instantly and aggressively moves off. It's literally gapping, right? We've got a gap here. Price is literally gapping up just to move off, right? That is our liquidity sweep. That is the best thing we want to see in trading, especially when we're bullish. So we've got our liquidity sweep. Put that down there. We've got our liquidity sweep. Price quickly and aggressively moves off in the opposite direction. Now, I don't look at marking structure, but if you do, here's your marking structure shift. All right, let me just mark this out. I don't look at market structure because I think it's a bit of a distraction because liquidity is all you need. The moment this body essentially, or this body really, once it closes above these highs, that's your market structure shift. I don't look at it personally, but if you want to, there's another thing that will add to the probability. And all you need is any sort of retracement afterwards. Once you've got this whole framework of liquidity on the higher time frame, that gives you your direction. Liquidity sweep on the lower time frame, price has moved in the higher time frame direction. Any entry pattern after that, any entry pattern on the retracement will do. So I'll give you literally 3 entry patterns here. So we've got a fair value gap. It's just the gap between this candle here and the candle there, right? The gap between this candle and this candle. That's a fair value gap. You could enter on that fair value gap, right? That could be your entry. You could, look at this, right? Look how it's always beautiful, isn't it? Look at how the bodies are like holding in the fair value gap, right? Look at that. And then the wicks are doing, are like poking out, right? This look for your notes. The wicks do the damage and the bodies tell the story. The body is smart money. The wick are retail, right? These are retail traders randomly buying and selling for no reason because they only look at the 1 minute chart. Smart money are the bodies, right? The body is smart money. So yeah, it's pretty interesting how like the price was just holding in that fair value gap. Like it wicks out, but the bodies are in the fair value gap. But anyway, doesn't matter, right? Another entry pattern can be this little gap here. Now, for those who know, this is called a volume imbalance, or at least I call it a volume imbalance. Now, this has so many different names. Someone on Twitter was asking me about this. I had no idea what he was talking about, but he was actually talking about this. And it does not really matter. You very rarely get this, right? You very rarely get this entry pattern here. So, I would personally say not to have that as your entry. But what I would say is this right here, this volume imbalance, where it's just, see these 2 wicks and there's no bodies overlapping. I'm going to try not to put my cursor on it because it does that thing, but you get what I mean, right? You get what I mean? See these 2 wicks overlapping because there's only wicks overlapping and there's not like a body that there is for a fair value gap. That means that volume imbalance is a stronger draw than a fair value gap. Now, what that means is that price is more likely, it's more likely to come to this volume imbalance than it is to a fair value gap, right? A volume imbalance is a lot stronger than a fair value gap. It's a lot more important. So that's what it's a bit interesting, but it's not really that important. The last entry, and I think this is probably the best entry, just by looking at the price action, if I was on the chart, is you see this order block here. The last down close candle before the up move is your order block. Now, there's 2 ways of entering on the order block. The first is the wick, right? So people could, let me just mark this out, right? People could say this entire thing is the order block, right? And then they could enter right at the wick high and put their stop loss. You'd have to put your stop loss at liquidity sweep low, but they would say that's an order block. That's true. You can enter on that. Me personally, I always like the bodies of an order block, especially when it's quite a big body. The only time I'll ever use the entire order block candle is, let's say it's a doji. Let me try and draw a doji out, right? Let's say you've got like this can be awful in it, but let's just imagine like this was like the body, right? The body was like here, a tiny little body, and it had like, it's got huge wicks. Like if it's a huge doji sort of candle, then okay, by all means, use the whole thing. But right here, the body is the most important part. So for me, I'm just going to enter like this, right? On the order block body. Now, for your stop loss, it's so important. The stop loss always has to be at liquidity sweep low. always has to be there, because I always say this, but I'm gonna keep saying it so everyone watching this is profitable. Very, very unlikely, right? At price, because price came down, just take out stop loss orders and then moved up. Very unlikely price going to come down, take out stop loss orders again, where it's already done that. The whole point of price coming down here was just to take out stop loss orders. It's very, very unlikely that price is going to come all the way down, take out your stop loss, and then move all the way up, right? That is the power of waiting for a liquidity sweep. Because how many times this used to happen to me for years? Let's say you were bullish on the higher time frame, you kind of understood liquidity, right? You kind of understood, okay, I just target highs and lows on the higher time frame. It's pretty easy. You get the direction, right? Then you buy as price comes against you. Price will take out your stop loss and then instantly go to take profit. The reason that happens, and it's so annoying, is because you don't wait for a liquidity sweep. So once you wait for a liquidity sweep, you're good to go. So any entry pattern will do. Stop loss always at liquidity sweep low. And then the take profit. For me, I always say this, I just aim for a 3-to-1. I never aim for more than it. You can, if you're on the 1 minute chart, I guess you can, right? And if I was on the 1 minute chart, just looking at this price action, I would aim for this high here. I'd aim for this high here, right? Lots of liquidity at that high. And let's just aim for this high. What do we get? We get about almost a 5 risk to reward ratio. Now, I'm not advocating like to always, aim for like a 5-to-1. But, if you were doing like a prop rim challenge or the past in a week, not the worst idea in the world, especially when you've got all this framework behind it. Higher time frame bias, lower time frame liquidity sweep, and obvious strong liquidity. You can do it. And this is so important, right? The only thing I'll say, right, is do not aim. Let me just remove this. Do not aim for the key daily target unless it's really like if it's likely for the day. Do not aim on the 1 minute chart to try and target this, right? Because it's insane. You don't need to do that. The only reason we use the daily chart or the 4-hour chart for liquidity is to give us a direction, right? That's it. That's it. Now, if price was all the way up here, then yeah, by all means, just target around the 1 minute chart. But price is all the way down here. Don't hold for like, weeks trying to get to this position. You don't need to do that. You just need a free risk to reward ratio. And for me, because I think that's like the golden zone. But with this strategy here, you can get an insane win rate, absolutely insane win rate. And the good thing is, if you're on the 1 minute chart, I mean, you can almost find a setup every day. Now, I'm not saying to trade every day, obviously, but you could find a setup almost every day, especially if you have like 2 pairs as well. But yeah, it's all you literally need to be a profitable trader. Liquidity is so important. It's the most important thing. It's single-handedly it's the thing that made me profitable. I had no idea what I was doing until I understood liquidity. Now, I understood liquidity, on the daily chart, like I said. I did not understand liquidity sweep until about 2 years into trading, right? And it took a lot of pain for me to figure that out because I'd get the direction, right? I don't know about you. You might be similar. I'd get the direction, right? But I'd always get stopped out consistently. It was so annoying. The reason why is because I never wait for liquidity sweep. So that is how you trade liquidity. Absolute masterclass. So many people asking for this video. So there it is. There is liquidity summed up. And if you want like another trading model, like a full PDF and stuff, and includes their value gaps, it's in the comments down below. It should be the pinned comment down below. A full free trading model, everything you need, all in like a nice PDF. Other than that, make sure you like and subscribe and leave a comment. Let me know if you found this video helpful. And I'll see you guys next video. Peace.